Welcome back to Jimmy's Diner. Earlier, I explained just how important same-store sales growth is for the restaurant cohort and how good comps can propel the best of the restaurant stocks much higher. Now it's time to look at the losers, the companies that reported lousy, uninspiring same-store sales growth this past quarter while most of their peers were taking off, the kinds of companies where you never know what you're going to find in the food. Drop your pants for... Jeez. When things are going right at a company, it's easy to get your head around the story. But with losers, or to be more diplomatic about it, underperformers, you need to do a lot more analysis to figure out exactly what went wrong. Sometimes there's an ugly data point that signals larger trouble. Sometimes a good company will just stumble, and its stock will get head slammed, creating what could be an honest-to-God fabulous opportunity. So now I want to look at the restaurants that reported the worst same-store sales numbers to see if those figures are truly indicative of a poor overall performance and whether it's not too late to get out of the stocks. We were focusing on getting in. Now we're going to be talking about whipping up some sales. Let's start with the don't touch group, the stocks of restaurants with bad numbers that I wouldn't touch with a 10-foot pole or a 6-inch potato strip. First, there's Noodles and Company, which doubled on its first day of trading after its IPO in 2013. But since then, wow, it's been a total dog, with the stock now trading slightly below its IPO price. In its latest quarter, Noodles reported a measly 1.3% increase in same-store sales, which was an especially awful result considering how well most other restaurants were doing over the same period. But this wasn't just one bad quarter. It was the fourth straight quarter of hideous comps. And at this point, it's become clear that investors really have no reason to trust Noodles or the people running it. So it's no wonder the stock plunged 31% in a single session right after Noodles reported. And even after that decline, you know what? The stock's still expensive. Trades at 32 times next year's earnings. It's quite possible that those estimates, again, are too high. It's the sand disk of restaurants. But not every restaurant with awful same-store sales is in dire peril with a stock that needs to be sold and sold aggressively. There are some special circumstances where disappointing comps don't necessarily mean anything at all. Two of the largest restaurant chains out there fall into this category. The first is McDonald's and the second is Yum Brands, each of which saw their same-store sales decline by roughly 1% this past quarter. However, both McDonald's and Yum are going through high-level strategic changes that make their near-term results less important than what management could potentially accomplish over the long term. Normally, I would say I would not touch these stocks even with, holy cow, a 10-foot pole. But the fact is that when you're this bad, things look up to you. When McDonald's reported its latest quarter, this is one heavy 10-foot pole. Investors basically shrugged off their declining same-store sales, with the stock getting dinged for just 1.5% the day it reported. The reason McDonald's didn't get slammed, part of it has to do with transparency, as the company reports the same-store sales metrics monthly. So it's not likely this quarter was not a surprise. Meanwhile, many investors were betting that another bad quarter would cause the company's CEO at the time, Don Thompson, to lose his job, which is exactly what happened. Thompson resigned a week after the quarter, and Steve Easterbrook was named his replacement. Given how poorly McDonald's performed under Thompson's tenure, it couldn't be touched with a 10-foot pole, and its desperate need for turnaround. This was a situation where a not-so-hot quarter actually led to a pretty positive development. One last reason why McDonald's didn't get crushed. It's got a monster dividend. Yields 3.5% at these levels. When a stock has yield support and the dividend is as sacred as it is at McDonald's, there's only so much, only so far it can fall before buyers start swooping in. In the case of McDonald's, whenever the stock slides down to the $90 level, where its yield starts approaching, say, near 4, investors start treating this one as a bond market equivalent, and the stock rebounds. In short, when you're as big as McDonald's, declining same-store sales are really just one piece of a much larger story, and a stock that you wouldn't touch with the proverbial 10-foot pole suddenly becomes something you can't get enough of. All right, how about Yum Brands? That's the parent of KFC, Taco Bell, and Pizza Hut. In its latest quarter, Yum saw a global decline in its same-store sales of over 1%. But its stock actually rallied in response, rising 2% the next trading session. And it's now up more than 6% since before it reported. Just like McDonald's, Yum's weak comps were already a known factor. In the previous quarter, the stock got annihilated in reaction to news about bad meat in China, their largest market. So we knew the company's results wouldn't be so hot. This is a case, though, where low expectations can really soften the blow of weak numbers. And with Yum, the stock actually rallied because the news wasn't quite as bad as people were expecting. Because what happened is they had lowered the bar so much that it was easy to get over. It wasn't like one of those, like Lindo thing, we're like limbo. You know what I mean? You get it? All right, one more thing. Shake Shack just reported last week. They delivered a 7.2% increase in same-store sales. This one got a mixed reaction. Initially, the stock got pounded into hamburger meat, but it ultimately ended up closing plus 2% higher that day. I saw it go on because it was happening right during at Scott Wapner's show, and it continued to climb. That's about a bar being set for the newly public company. While I like the burgers, I think it's a rat race out there. And now with this benchmark, Shake Shack's a part of it. From here on in, it will be judged by the numbers, not the taste of its burgers. That said, I think the bar's been set low enough by this report that I bet Shake Shack will be a keeper in the way that Chipotle was when it first started. So here's the bottom line. After analyzing the same-store sales of all these restaurants, winners and losers from the latest quarter, the moral of the story is that you can't look at these numbers in a vacuum. You need to analyze the trend to see if a restaurant's comps are accelerating or decelerating, because that's what determines whether or not the stock goes higher. I would stay with Jimmy.